So this week was a very interesting week in that the market started to drift higher on Wednesday, and then it was very schizophrenic on Wednesday. It was up a little bit, and then it ended up down. And I would have adjusted my long call spread on Wednesday if I would have put this trade on, especially on the close of the market. Now, what ends up happening here, and this is what I want to highlight, is that the short call spread, and I want to make sure I got my strikes right, is $15.35. So that's a heck of a lot of credit for 5 days to expiration by just selling an at-the-money call spread here. Remember what we paid for our trade, $8.75. This net credit is now $15.35. Our break even for the trade is 58.2875. I got that right. 58.2875. All right. I do have a degree in math, but I don't like doing it on the fly in an event. And if I look at all of these, here's my simple adjustment. I don't care that I'm paying $3.40 for this butterfly. I know my max upside on the butterfly, the distance basically from this strike to this strike, is going to be 15 points or $15. I know that that's the maximum that it could be. But if I'm doing this trade, if I'm looking at this trade and I have this position on, if the market goes up from the beginning, no worries. If I wake up and SPX is up 0.5%, which is a good move in the SPX, very rarely do you get the type of move on a percentage basis that we get today. So if I do this and I have this on for $5.35 and the market moves to the point, let's say it goes down 20 or 30 points in this spread would start trading for about half of this value. And I just wanted to make sure that that was all correct. So if the market goes against us and we're losing on our spread, so in that instance, our long call spread, exit full screen. No, I didn't want to do that. Our long call spread would be, we'd be losing on this trade. This trade would come down and this spread would be trading somewhere close to around $4 on this trade overall. So I put the trade on for $8.75. The market goes up, I sell, I'm out of the trade. The butterfly was trading for $3.40. But if the market goes down, and if I ever see this credit spread trading for $2.50 or around $2.25, I'm going to roll into that spread, and then I end up taking the net debit of this trade down. Let's say we sell it for $2.25. So $8.75 minus $2.25. That would be $6.50 overall. So that would end up being my max risk on the trade. And then I'm long a butterfly and I'm hoping that the market will bounce back. So I have two different options that I can do here. And if I had a platform, I would go in and just run it through the platform. But I have two different options on this spread. If I put this trade on and I start out in a butterfly, it costs me $3.40. I'm going to pay a lot more for the butterfly. If the market goes down and the market is going against me, this credit spread, this is my signal to trade. If I see this credit spread trading for around $2.50 or between $2 and $2.50, I'm going to sell that trade, and then I'm going to be into the butterfly, and I'm going to have a 15-point wide butterfly, and I'm going to reduce my risk. So instead of just getting out of this trade because the market went down and I'm paying, and I sell it and I close the position for $4 or $5, I'm going to adjust the trade, sell this net credit spread and try to bring in at least $2 to $2.50. And then I have a 15-point wide butterfly that I ended up paying $6 for. And that's my chip in a chair. If the market goes down and it goes against me, then on that trade, I'm okay. And I can still be in the position and have a chance for the market to bounce back and go towards my strike on my short butterfly at expiration. So the way that I really kind of look at this trade is that if I'm starting out in the long call spread and the market is, I start out in the long call spread on Monday. Hopefully Tuesday I can make it by. The market kind of stays the way that it is. When it gets to Wednesday, if the market has drifted about 0.5% lower, then I'm going to look to adjust that trade at that point in time. If I can adjust it on that day, now I'm into the height of time decay, especially in the S&P 500 index. So we have all the time decay on Wednesday, all the time decay on Thursday, and then on Friday it becomes a very interesting day if we get the markets to come back. If not, I've reduced my overall risk of the trade. I've taken a few dollars off the top. I added no more additional risk because all I did was roll into a butterfly, and hence the reason why I use the analogy you have a chip in a chair.